my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. Chicago soybeans. The move up from the October 2023 V bottom was capped each turn by the now declining flatlining short medium moving average, currently at 1296, the declining medium moving average, currently 1308, and finally by the declining long moving average, currently at 1340, as well as a band of previously highlighted congestion between 1378 to 1409. All these resistances eventually eroded the move higher and in the process created a mini head and shoulders top over early November to early December. When the break lower happened, it was down through the neckline of this head and shoulders top, and at the same time the lower bull channel line, plus the 50% Fibonacci line of the late May to early July move at 1349. As you can imagine, breaking all these trend lines so closely associated with each other as they were back then, as well as a 50% Fibonacci line, required some considerable force, and prices have dropped ever since, though there has been some hesitation this past January, but the bearishness has reasserted itself this week, with low closes not seen since November 2021. 7 weeks ago I laid out some potentials below that eventually became targets for these patterns. Thus, and I quote, "For the mini head and shoulders top, we have a primary target in the 1312 zone, but harder to reach secondary target X in the 1277 zone. For the bull channel, we have a primary target X1 in the 1308 zone, where secondary harder to reach target X2 in the 1270 zone." End of quote. As you can see, the market reached all the potentials and target zones by the middle of January. So what's next? Well, the only thing that has become clear is the little hesitation we have had during the middle to the end of January. Though Friday's low close, is comforting to the bears out there. I would only add a caution that we are close to the low seen in May last year, and we all know how that created a 3-day bullish doji star pattern that led to a really good V bottom and the rise thereafter. We have a support below at the 2021 low at 1181 and the December 2020 low at 1142, and of course the 61.8% absolute Fibonacci at 1106, but not that much beyond that right now. I've also drawn an early July to mid-November 2023 bearish Andrews picture, more as a way of expressing the bearish angle of attack than for anything else. The market is just below the middle time, currently at 1211. The only other thing to bear in mind is not here, but in Chicago soybean meal, and that is the well-highlighted annual key reversal down we saw there for 2023. Not directly related here, but not worth ignoring either. Chicago soybean meal. After establishing a horn top in mid-November, something I'd cautioned about 10 weeks ago, prices dropped down through all the following supports that now again become resistances. They are the short medium moving average, currently 392 even, the medium moving average, currently 397.20, the long moving average, currently 404.70, the 50% Fibonacci lines for the October 23 to date move at 404, the October 2021 to date move at 403.60, as well as the 50% Fibonacci line, the August 2020 to March 2022 move at 390, as well as the 2023 low at 386.30. In the process of heading low, the market also created two lagging indicators, dead crosses. The short medium moving average, currently at 392 even, down through the long moving average, currently at 404.70, and down through the medium moving average, currently at 397.20. In mid-January, prices hit the congestion zone, 363.70 to 368.80, and this was where I had cautioned 7 weeks ago we might see some hesitation, as this was the low back in October 2023 that led eventually to the big horn top in November last year. Well, prices sliced through this congestion, but in the process the erosion caused and created another hesitation, this time between the original hesitation overhead 363.70 to 368.80 and the next smaller hesitation below between 347.20 and 349.20. This hesitation has only just started and I am not certain as to its strength, other than to say below this we have congestion at 342 and then again between 336.30 to 338.10. This latter one containing a 61.8% absolute Fibonacci line at 336.30. Yet, all that being said, there is one key feature I need to once again repeat and emphasize. I raised it 33 weeks ago and ever since, and which actually came about at the close of 2023, and that is 2023 was an annual key reversal down. This hangs over this market more than anything right now, and all action should be seen in the shadow of this pattern. Chicago soybean oil. The September to November 2023 bear channel had been the main driver lower in this market over autumn 2023. The main congestion band between 56.34 to 59.44 was overcome by early October, and prices pushed lower, easily down through the February 2013 high of 54.15 and the March 2013 high at 51.26, though not so through the interesting 38.2% Fibonacci of the big March 2020 to April 2022 move of 48.95. This surprising support slowed and stopped the market, turning it higher, and 11 weeks ago caused a break higher up through the upper bear channel line and created a new nascent bull channel. This 4-week-old bull channel ran out of steam, caused by the combination of the sine wave that is highlighted in green of the declining short medium moving average, currently at 49.38, and the same February 2013 high support that is now resistance at 54.15. In early December last year, prices had broken out below the newer nascent bull channel line, though the move lower has not been as easy as it was back in autumn 2023. Eventually, at the turn of the year, the market broke down through the 38.2% Fibonacci line. We had the opportunity to form a very extensive bearish half hesitation, with the bear channel being one leg and the bull channel being the hesitation. Potential below as low as 40 even. However, decline, and we have had a decline, has been shallower than in autumn last year. Interestingly, possibly being dictated by a now shallowly declining short medium moving average in green, highlighted in green. Prices are now down to the area of congestion we saw in May 2023, consisting of 3, maybe 4 possible bands. They are the 44.68 to 45.04, made up of the 2014 high at 45.04 and the May 2013 low at 44.68. Then the tight 43.80 to 43.94 zone, made up of the 50% absolute Fibonacci line at 43.80 and the April 2014 high at 43.94. Then the interesting 42.65 congestion, which has the neckline of the October 2019 to February 2020 move, head and shoulders top move, running through it, currently at 42.54. And I suppose we also have congestion at 41.15. I mention all these because some 30 weeks ago, and numerous times ever since, I said the following about the big descending wedge pattern that was on my daily chart back then and is off the top of my, off the top of my chart. I said the following, and I quote, "I would consider the descending wedge pattern may, just may, have lately morphed into a possible scallop pattern." Now this is a big pattern idea. A market decline since autumn last year fits in with this idea. With the expectations I voiced of eventually witnessing a fall down to the zone of the May and June lows between 48 even to 46 even. Which is where we are now. I am keeping a very, very close eye on this idea, as any significant breakdown below the 48 to 46 zone could signal the start of this move lower. Two things to bear in mind. Firstly, this is a really big pattern stretching from November 2022 to date, so do not expect any immediate sharp movements. Secondly, data indicates that at about 3 out of 4 times the market breaks lower, so please just be aware of that. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.